Uber may be one step closer to going public. The Wall Street Journal is reporting that the ride-sharing company is working with several banks to set up a $1 billion line of credit. Bain Capital Ventures Managing Director Matt Harris is with me now. Also with me, Wall Street Journal reporters Dana Mattioli and Telis Demos, who broke the story. So, Matt, wonderful to see you in New York. Dana and Telis, thanks, and great scoop, obviously. So it seems as if, I'll just put this out there, Uber is about a year from going public. Matt, what is your take?
That'd be the traditional pattern.
Okay.
That's why you do this sort of thing. You get to know the underwriters, you continue to build your capital markets brand name, and then you go public.
And tell us, you've done tons of reporting on these companies going from private to public. So to Matt's point, they are out there now talking to 6 or 7 banks. How much are you willing to commit? At what terms? Who gets to be the lead, right? These are all the conversations happening.
Exactly. This is an opportunity for banks to show, just how much they love Uber and, sort of say how much they're willing to pony up, at what terms, and it's also an opportunity for Uber to kind of get to know each of the banks, get to know their teams and things like that. Though of course for Uber, I mean, this is a company that has already done a lot of financings. They know all the bankers and things like that. So it's far from just sort of Uber's introduction to the capital markets, but it's like a key step kind of on that path.
Speaking of key steps, Dana, I have to ask you, while all the bankers are taking meetings with Uber and Uber's team, what's going on with Lyft?
So these two have a very fierce rivalry that we've written about before. If you want to invest in Uber and look at their books, you can't even talk to Lyft. So if you're talking to 6 or 7 banks, you would think that those banks would be prohibited from then working with Lyft.
Yeah, because you're not really, as a banker, supposed to be playing on both sides of the table, right?
That's right.
In theory. All right. Well, you want to say something, Matt?
Well,
I feel like.
Many banks bring different competitors public. I think what's particular about this is the amount of rivalry between these two companies. So it would be unusual for a company to deny a lender or an underwriter the opportunity to work with competitors, but if anyone's going to do it, it's Travis.
Yeah, I was just going to say, right, if anyone is going to just press the nuclear option, it's him. Tell us.
So we saw a similar thing with JD and Alibaba last year, and it was a situation where banks sort of had to choose sides. Like there was a time when, the banks that ended up leading JD's IPO had to say, you know what, we're just not going to do work with Alibaba because we know we're not going to necessarily lead Alibaba. We think we have a shot at leading JD's IPO, so we're going to pick that. So it'll be interesting to see who's not in the credit facility as well, because that might tell you something about who's decided to say, you know what, Uber's a frenzy. Maybe I'll back away and end up going with Lyft.
Okay, so speaking of frenzy and like the what not to wear of bringing a company public, no one, and I know it's far away and I shouldn't keep referencing it, but nobody wants to be the next Facebook, right? So Uber is huge at this point. I mean, it's the largest privately valued company. Matt, what do you think as a former reformed banker? What parts needs to move so this does not become Facebook's second version?
Well, this will kick off a separate frenzy, which is NYSE versus NASDAQ. Sure. Competing for who gets the listing. And the NASDAQ Facebook debacle that you point out. Now, underwriters had, some blame in that. It was priced maybe
Morgan Stanley,
high.
Though we're not going to name names.
We're not going to name names. But there was also the trading debacle. I mean, it was a lot of egg on a lot of people's faces. I think it probably serves NYSE, and I think Morgan Stanley's recovered quite nicely from that. Yeah. And they've gotten a great mandate since then. But this will be the same kind of retail feeding frenzy that Facebook was at the open. And they've got to choose the right exchange and underwriters to manage the logistics.
So speaking of that, when your dentist is asking you, should I buy Uber or not, is that a danger side? I'm not actually being funny.
It's the famous shoe shine boy example. That's when you sell. I think the issue with Uber is not so much that Americans are obsessed with the stock market. It's that Americans are obsessed with Uber. So I think it's more of a bull signal than a bear signal in this particular case. Uber has affected the lives of many tens of millions of Americans and beyond. And
when your company becomes a verb, right, then you know, for better or worse, it's here to stay. But Dana, we were talking about this earlier. I mean, Carl Icahn, speaking of aggressive sales personalities, has actually put money in its competitor, in Lyft. Mm-hmm. Does it matter at this point, or is just Uber the gold standard?
No, I still think that they're the underdog. Uber has this $41 billion valuation. They're out there raising more money. I think it's probably a good investment for Carl, but I mean, Uber is clearly the top player in the space.
So tell us, any danger signs with just the size of Uber? I mean, this, listen, this is going to be tricky even for very experienced bankers to pull off.
Absolutely. Size is a blessing and a curse. It's when you've got a company that's already worth, $40, $50 billion. By the time it gets to an IPO, who knows what the market price will be. And that means even if you want to sell a small stake in the company, say just 10%, you're talking about, $5, $6 billion IPO. They'll probably raise some money for the company itself. You're talking about a $10 billion IPO. To get that done, you've really got to sell 5 times as much. And given the fact that Uber's already raised so much money privately, a lot of people have a lot of Uber stock already. So you're going to need to do a job of going out and finding even more people who want to own a big position in Uber. Now, a company like Uber, there's probably a long list of, say, foreign institutions, sovereign wealth funds, hedge funds who want to play the stock, mutual funds. So it's not that there's, they might end up doing it okay, but it's a trick to do an IPO of that size and get the same result that you like to see in an IPO, which is that nice kind of pop after the deal and things like that.
That makes public investors feel as if they are not getting ripped off behind the scenes. Telis Demos, Dana Mattioli, Matt Harris, thank you very much. Telis and Dana, back to the newsroom. Matt staying with me.